Today, I want to explain how prime brokers and market makers are worried that AMC will experience an extreme price surge. I also want to talk about how they're desperate to borrow real shares in an attempt to make their short positions legit. So stay tuned and let's make some money. Now I'll dive straight in with the key information. So, I want to start by saying that this is an old tweet, so don't come at me for using old material, but if anything, this tweet is more important right now than it was back in June of 2021. So, Manpreet tweeted saying Wall Street's top brokers are quietly tightening their rules for who can bet against retail traders' most popular stocks, according to a report from Bloomberg. It says that Bank of America, Citigroup and Jefferies Financial Group are among firms that have adjusted risk controls at prime brokerage operations. And it says banks are trying to protect themselves against fallout from extreme surges and dips in companies including AMC, GameStop, Microvision and many others. So this basically means that prime brokers are only allowing specific hedge funds or specific market makers to bet against AMC stock. So that likely means we're not betting against other retail investors, we're not betting against smaller hedge funds, we're only betting against the biggest 1% of the 1% of those largest hedge funds and market makers. And as these major banks are trying to protect themselves from the fallout of extreme price surges in AMC, GameStop and other meme stocks, it's likely these banks are demanding massive collateral. Now we know that Citadel are using a special type of margin loan that's different from regular margin loans, aka instead of when a stock price falls, that trade being liquidated, as long as Citadel is meeting their monthly payments, they don't end up being liquidated. But it also means that when AMC and GameStop do experience their next extreme price surge, these major banks, these major institutions and their largest hedge funds have significantly more to lose. Because it's not individual trades that are being liquidated, as long as these hedge funds meet their monthly payments, it's likely going to be the entire hedge fund that comes collapsing down. aka when Citadel, these market makers and the largest 1% of hedge funds run out of real AMC shares to borrow and run out of cash, the music stops. And the music doesn't just stop in a small way with one individual trade being liquidated, it's likely the entire market making business of Citadel will come collapsing down. And that is why these market makers are desperate to borrow your AMC shares at any price possible. AMC to the moon tweeted saying I could go full on Judas right now and loan out my shares and quit my job. But he said I'd only be hurting myself and my brother and sister apes. He said my account is a cash account and therefore he's not using margin. And he said as a result, his shares are definitely not loaned out and he's not even remotely tempted to do so. AMC to the moon is yet another user who's received an email requesting his AMC shares to be lent out, with an interest rate this time not of 70% but of 77.6%. And as Stephanie tweeted, she said they don't offer this kind of money if they don't need what you own. She said this might seem like a lot of money, but it's nothing compared to the mother of all short squeezes. And the AMC cheerleader has asked Fidelity why AMC stock is in demand and why it's only AMC stock. And she also asked what is the true current percentage offering for the fully paid lending program, because this is yet again another user that's now being offered 79.5% interest with a hypothetical monthly income of $13,000 per month. And she said that AMC appears to be an in-demand security that some shareholders have been eligible to receive massive interest rebates. She said currently some shareholders are being offered an annual interest rate of 79.5% and a hypothetical monthly income of over $13,000. And she's curious to Fidelity as to why exactly this is being offered for AMC shareholders. But as I said, it's likely because these market makers are desperate for shares to ensure that the music doesn't stop. And to tie that in, this also comes at a very interesting time when BlackRock has just announced a massive recent layoff and obviously their $1.5 trillion loss. And guys, if you haven't already, be sure to join me over on Moomoo, who is the sponsor of today's video, by using the link in the description below. You can currently get up to 17 free stocks, entirely commission-free trading, free level 2 market data, and Moomoo is very easy to use with tons of technical indicators and advanced charting tools. Moomoo has 24/7 customer support and you can trade around the clock using their very simple user interface. Now we know that BlackRock for the year of 2022 took on a $1.5 trillion loss, bringing their $9.5 trillion fund down to only $8 trillion. But on top of that, BlackRock also plans to let go of around 500 staff or 500 members of the workforce in order to try and mitigate the current market conditions. Larry Fink said the first half of 2022 brought an investment environment that we have not seen in decades, and that's why BlackRock is currently having one of their worst losses on record. So it seems these market makers are desperate to borrow shares because these prime brokerages are restricting who exactly can bet against AMC and are likely raising those margin requirements. And as I said, this also comes at a time when one of the world's largest asset managers, aka BlackRock, is struggling. If BlackRock ends up going bankrupt and cannot continue loaning out their AMC shares, it's likely these market makers would be screwed. You may say, Tom, surely there's no chance of BlackRock going bankrupt, but I think Alessio Urban has tweeted a very interesting chart. He said as a great way to start the year, the US large bankruptcies in January touched the highest amount since 2010. So this chart here shows the number of companies that have gone bankrupt with over $50 million in liabilities. Now over the last 10 to 15 years, this is averagely held at below 10 large bankruptcies per year. Obviously this did spike in 2020 for those pandemic lockdowns. Obviously during the lockdowns, many businesses struggled, especially retail businesses, and obviously some did go bankrupt, especially some of the largest companies out there. But 2023 has absolutely destroyed that. In the last month and a half alone, we've seen over 20 large company bankruptcies. So in the first month of January and the first few days of February effectively, we've seen more bankruptcies in 2023 than we've seen over the last 10 to 15 years. So therefore I can only imagine just how bad 2023 is going to continue getting and how many more large companies we're going to see going bankrupt. And I also really like this Reddit post about the AMC reverse split. He said, you guys really need to understand the due diligence. He said a new QSIP number literally means short positions have to close out until they cover their failed delivers. And he said, not only does that mean the price will be jumping to 8 plus AMC times 10, obviously for the 10 times reverse split, but at the same time, they will be forced to buy back the stock at that higher price. And obviously as they have to buy back the stock to close out of those FTDs, it means they can't simultaneously short the stock, creating new FTDs at the exact same time. Because of that new QSIP number, they have to close out of those FTDs first before they can resume shorting. And therefore that will cause the price to naturally go up as they buy back all of those AMC shares to close out of those FTDs. And this poster on Reddit believes this is the most realistic catalyst of the squeeze imaginable. And he said at the same time, while these hedge funds have to buy back these AMC shares, the supply of AMC will go way down. And he said by law of basic economics, the more we hold with a decrease in supply and an increase in demand is potentially a huge catalyst as well. Obviously, if demand increases because these shorts need to close out of their FTDs and supply reduces massively, that is a case for a price to increase. And he said that's the same reason why you see so many people considering voting no because of the massive FUD campaign. And that's why he says, who cares if you've got 10 times less stock, because the shares will be worth way more than 10 times the value. And finally, something very interesting that ties back into that last Reddit post is this tweet from Phil For Real. He tweeted saying tomorrow is the 13th consecutive day that AMC potentially could be on the New York Stock Exchange's threshold security list. Now obviously a stock is only allowed to stay on the regulation SHO list for a maximum of 13 days. Those FTDs have to be closed out and a forced closeout requirement will apply. Now again, I'm sure in the past we've seen other stocks remaining on this regulation SHO list for an extended period of time, but AMC has never stayed on there for 13 full days. I think AMC is a significantly more popular stock than many of those smaller stocks that remain on the regulation SHO list, and there's a lot more prying eyes. And therefore I do think the price of AMC could really start rising up towards this reverse split date at the time when it could potentially go wild. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.